Legacy financial advisors and typical retail financial creators want to tell you that investing in the S&P 500 is the safest, best investment you can make. They tell you, do not ask any questions. Do not try to be smart. Just do what you're told and buy the index. It's the safest, best investment. And I'll be honest, I've been looking at specific companies, brands you know. McDonald's, Home Depot, Domino's, Starbucks, Nike, Boeing. And the reality is brutal. When you actually take a close look at the balance sheets of these companies, what is going on, and this is what your 401k is investing in. Every time you invest in an S&P 500 ETF, you are providing life support for almost, I would guess, 30% of companies in the S&P 500. I mean, this is me just deep diving a few companies in this video, but there's more and they just keep popping up. And it's what I've realized is these companies are now run by middle managers who are incentivized by Wall Street to just hit earnings per share. And this is creating so much issues. It removes price discovery, and it is just, you're funding slow, stagnant zombies. Let's look at the true returns of the S&P 500. All the dollars in existence in 1959, 286 billion. Today, 22 trillion. What was the S&P 500 in 1959? It was 55.33. Today, it's 7,394. Now, the difference between the growth of the money supply and the growth of the stock market over nearly 7 decades is a mere 0.82% per year. This means that 89.2% of the long-term price appreciation of the S&P 500 was mathematically nothing more than a shadow matching the dilution of the currency. The tiny remaining 0.82% per year represents the actual real organic productivity and efficiency gains of corporate America. So exactly 95% of the variance in the nominal price of the S&P 500 over time is directly explained by the variance in the M2 money supply. Only 5% of the long-term price variance can be attributed to individual company performance, interest rate changes, politics, or earnings reports combined. So Wall Street want you to believe that the stock market goes up because corporate managers are geniuses who are constantly innovating, but the math tells you a darker story. 90% of the S&P 500 return is just tracking the printing press. When you buy an index fund, you aren't investing in growth, you are just buying a mathematical hedge against the slow death of the US dollar. But let's look at it. Let's start with Home Depot. What's wrong with Home Depot? This is a big problem with so many investors. They hear Peter Lynch. Peter Lynch said, invest in what you know. So they say, well, I know Home Depot because I go there and buy things, so I should invest in it. If you invested 5 years ago, you would be up 5.67%. So let's look at this, because you're going to notice such a direct correlation between all the companies that I look at in this video. They are all subject to the current macro environment. So whatever is going on with interest rates, whatever is going on with the Federal Reserve, geopolitics or whatever, that dictates their destiny. They're not in charge of their destiny. And it is shocking because all these companies have the same pattern. Their revenue was skyrocketed in 2021 and then it declines. All because of the interest rate environment. Remember COVID, there was $4 trillion injected into the economy, put into the hands of consumers as well. Stimuli checks straight from the government. So they go out and they spend money on Home Depot, Domino's, Starbucks, Nike, and all these companies. All the revenue shoots up. So what's going on here with Home Depot? Right, for a start, Home Depot net worth is $12.82 billion. It has long-term debt of $44.23 billion. What is happening with these companies is they are incentivized to take out debt and buy back their own stock. There's nothing wrong with buybacks. It's great for shareholders, but when you're using debt to issue the buybacks, it's a big problem because interest rates are now holding higher for longer. This means over the next couple of years, these companies are all basically betting that the Fed is going to cut rates or even US Treasury bonds are going to come down. And that's not really a good business strategy. Just hoping the macro environment is going to favour you rather than actual business innovation. Because think about it, you've got two choices. Imagine we are sitting at board of directors and we are now in charge of Home Depot. We have two choices. Choice one, we have to actually make this company better. We have to innovate the company. We have to come up with ideas. We have to grow the business. We have to increase net margin. Okay, that's the hard path. Or we can take the easy job. We can say, right, let's issue some debt, buy back the stock, and Wall Street will reward us. Yeah, let's do that. That is literally it for all these companies, legacy companies. They're taking that option. But what's happening now is interest rates are staying high. The bonds are going to come up to mature. And the rolling over the debt is getting more and more tricky. And the companies are finding themselves in a bit of a rock and a hard place. Because the debt is now catching up. They're having their own sovereign and debt spiral. And I've noticed something else. I always talk about return on invested capital, one of the most important factors when you're looking at a company. And it is. But the buybacks also disguise the true return on invested capital. When you actually add back all the stocks, the treasury stock, okay, when they buy the stock, it becomes treasury stock, it gets erased, it gets deleted. But when you add all that back to find out the truth, you find that the return on invested capital is less. Because, for example, I'm going to look at Home Depot, right? It's return on invested capital looks sky high at 28%. It looks like a tech company. But when you add back all the stock, the truth is it's a lot less. It's still good, 15% is still good, but it's going down. What's more important is the trend. Look at the trend. Between 2020, the ROIC is going down, it's going down. Because what they've realised is consumers are tapping out because they're just a victim of the macro environment, the economy. Do consumers have money? Well, the housing market freezes up because the rates are higher. No one's buying things from Home Depot anymore. So the revenue is stagnating and declining. So how do they start funding the debt? It gets more trickier to fund the debt. There's less free cash flow. More importantly, who is actually the shareholders in these companies? Vanguard, BlackRock, State Street, pension funds. These are automatic buyers. They don't look at the balance sheet. They don't look at the company and say, hold on, is this been ran properly? They just click buy. What's the market cap? Buy. Yeah? Your 401k, boom, goes straight into this company. Stagnation. So what did Home Depot do? They do what reactive middle managers do. They say, okay, look, our revenue is declining. We need to do something. So they tried to do B2B. It failed. So what did they do? They bought a company. Now, here's what they bought. They bought a low margin B2B company because they realized, you know what, we can't actually. We're helping the consumer, but we need big businesses. But our business is not designed to do that. We need bigger equipment. We need massive industrial special equipment to do this. We need a fleet of trucks. So they had to buy a business. And look at the price they paid for this business, right? The company revenue was about 10 billion. 10 billion, right? And they paid 18.25 billion, 16 times the EBITDA. And its actual net income about 75 million, add back depreciation, amortization, etc. I guessed its free cash flow 300 to 400 million. They paid about 60 times free cash flow for a business that net margin is about 5%. Now, do you know why I think this happened? In my personal opinion from the research, because this is the problem with if you're a public company, everyone can see everything. You can't hide. Your financial books are on there. People can see the stock price. So the private equity firm and the investment bankers were thinking, they're desperate. they need to show Wall Street something. Remember, these companies are slaves to Wall Street. They're desperate to stay in the S&P 500. That's their life support. Remember, they need to stay in it, and it's hard to get in the S&P 500, but it's also hard to get kicked out of it. So they bought this 5% net margin business, which has no cash flow, because in Home Depot, you walk in, you buy something, you pay it straight away. They're now supplying businesses, which will get like 30 to 60 days delays. There'll be massive maintenance capex because they've got a fleet of 4,000 trucks. But they had to do something. So, and plus, it's just the manager had to make a decision, so they went with that. What they should have done is bought it when their business looked like this. When the business was printing 20% increase in revenue, that's when they should have bought the business. Yeah, they waited until it was, they're bleeding and they're at a position of weakness. Then they buy the business. Reactive humans. This is how humans are. Reactive, not proactive. Yeah, we want to be proactive. We do things way ahead, way in advance. That's why we're all about architecture and strategy. Because look, everyone can see the weakness. So that's Home Depot for you. Yeah, if you invested 5 years ago, you'd be 5% up on your money. Your shareholder equity is negative, and its PE ratio, its price to earnings ratio, is more expensive than big tech. Yeah, but okay, AI is the bubble. Yeah, AI is the bubble, not Home Depot. Don't look at Home Depot. Home Depot's not a bubble. Yeah, but AI is the big problem. AI is the big bubble with companies that are actually making true revenue. Domino's is another S&P 500 company. This is what your 401k invests in. This is what your ETF invests in. Stock price doing absolutely nothing. Let's look at Domino's. What has Domino's done? It's revenue stagnation. It's growing, even after COVID, it only went up about 5%, 4%, 5%, 4%. No, there's no growth. There's no pricing power. It's a pizza joint. Shareholder equity minus $3.9 billion. So there's your shareholder equity, negative. Because what do? The same playbook. Let's just do buybacks. And now they're at their absolute debt ceiling. They can't keep doing buybacks anymore. So the stock price is now tapping out. Yeah, so there again, this is another example of where a company looks like a genius. It looks like see when you look at their return on invested capital, right? 45%, yeah. So they spend $100, they get 145 back, or $45 back. It looks strong. It looks like a tech company. But when you add back all the stock that they bought, the truth is it's about 13%. Still good for a franchise, because it's franchise. They don't take any risk, yeah. All the problems go to the franchisee. In my opinion, franchise businesses are the greater fool. You're hoping someone is crazy enough to buy it that doesn't understand business, so they just buy it, buy themselves a job, take all the liability, and the franchisee, the franchisor, or whoever, the company, they win. So Domino's is the same. Yeah. Remember, when money was cheap, they could take all this debt and buy back stock. These companies rely on low interest rates to survive, so they start buying back the stock. Wall Street reward them, and now the stock's crashing out. No excess liquidity. They're going to have to fund the buybacks with operating cash or new expensive debt. Borrowing at today's high interest rates is going to cause more problems, and they're absolutely growing slowly. And who owns the company? Vanguard, BlackRock, State Street, all the usual names. Translation: the ETFs, the 401k. Yeah, this is who you're investing in. And again, the PE ratio is more expensive than a big tech company. Yeah, but yeah, it's not a bubble. Domino's is not a bubble. It's like it's priced more expensive. I'll never understand it. Who's another one? Starbucks. Right? Let's look at Starbucks. Wow, what a surprise! Look, after COVID, the revenue went up 23%. Yeah, this is what I'm saying. These companies are not in charge of their own destiny. They depend on the Fed. They want the Fed to bail them out. They need cheap liquidity, consumers to have money, low interest rates, and everyone can spend on coffee. So what has Starbucks actually done? over 5 years, minus 6%. Blue chip company here, safety. Yeah. Most of the revenue growth was actually just price hikes, but there's only so how far can you increase the price of a coffee? Yeah, I mean, come on, coffee is coffee. How do you charge? They go for charging like $4 for a coffee to $7 to $8 to $10. It's going to get to a point where it's going to be like $20 for a coffee. I mean, it's not going to. How's that going to work? And look, here's your shareholder equity. Let's look at it. The net worth is negative $8 billion. Yeah, so that's your shareholder, your ETF that you fund, your 401k that buys into Starbucks, negative, because they're also running the same typical playbook. The return on invested capital looks amazing even if you add it back, because that's from their glory days. Because their glory days was like 2005. So they would generate huge return on invested capital. But we now look to the future. The future doesn't look great. These companies are just... You're investing in a company that is dependent on cheap debt, buybacks. It's not actually generating new growth. There's no innovation. Look at the debt. Liabilities, $40 billion. Assets, $32 billion. Yeah, so that's why they're starting to tap out. These companies are starting to tap out, and they're staying in the index, which is shocking. Nike. Now, Nike is different. Nike actually doesn't do debt for buybacks, but it's worse. This is worse because it's now a management issue. Managers are just letting Nike deteriorate. 5 years, minus 65%. Again, what a surprise. During COVID, they increased their revenue by 19%. These are all businesses from different sectors, all experiencing the same thing. When interest rates are cheap, everyone's a genius. When liquidity is flowing, and that's what pushes the stock market up. But it's all a sugar high, it's a sugar rush. What you'll find is wealth is not about a nominal number, it's about weight. Wealth has always been about weight. Remember, we used to use gold 5,000 years ago. 5,000 years ago, how much gold, what is the weight of your gold? And it's the same today. What you think about it is, Benjamin Graham said it, and the stock market is a weighing machine in the long term. Yeah, it's about the productive assets that you own. How many stocks do you own? Stop looking at the nominal number and track the true weight of your wealth. Massive recovery during COVID, of course. And the problem with Nike is, its balance sheet does look healthy. It's actually got shareholder equity. The problem is they thought they were invincible. They said, you know what, we can sell directly to the customer. We don't need to put stuff in the shelves in Foot Locker anymore. So they took all their products out of the stores, and their competitors just took the space. So you've got other trainers like Hoka and other brands took the market share. They thought they were too good. Then they're sitting on $7.5 billion in inventory because they trained their customers to wait for a 30% discount. So they destroyed their own their own pricing power. So that was more of a management issue. But it still applies. This is what you're still invested in this company, and it's still expensive. The worst of them all is Boeing. Worst for the last. Boeing. This is where bad middle managers running a company now becomes harmful. Look, who cares? Like, if Starbucks owners decide to use debt to fund buybacks, it doesn't hurt anyone, right? It hurts us as shareholders. It hurts people investing in the S&P 500 because they should be getting true returns, true price discovery. We're not getting that. But this is actually where it turns to actual physical harm. Boeing's a disaster. Like, look at the shareholder equity. Negative 20 billion. Negative 20 billion. Just wealth destruction. The ROIC is negative. Airline companies are just massively capital expensive. Just wealth incineration, these companies are, And the only time its revenue went up was obviously 23. Remember, after COVID had finished, everyone decided to go on holiday, vacation, 16% increase, and then plummeted. Because what had happened was the owners of the company, not really the owners, whoever was in charge, manager, said, instead of focusing on planes, let's do buybacks. Of course. Who knew? Surprise, surprise. Yeah, take the easy route. So what happened? Yeah, it was a financial engineering failure. Boeing was run by aerospace engineers who obsessed over building the safest, most advanced aircraft on Earth. And in 1997, Boeing merged with McDonnell Douglas. They took over the boardroom and they went on a buyback binge. Instead of spending cash on research and development, they decided to spend $40 billion buying back their own stock between 2013 and 2019 to artificially boost the share price. So what is the result of that? Planes started malfunctioning. Catastrophic 737 MAX crashes in 2018 and 2019, and a door plug blowout completely shattered the company. This is what I'm saying, just short-termism is destruction. It's dangerous. This is the typical view of these corporate managers. They look 2 feet in front of them. Yeah, what will give us return over the next 90 days for Wall Street to give us a thumbs up? Just buy back the share, buy back the stock. So your 401k is funding corporate failure. Boeing's the best example, without question. Without question. Every time you buy the Vanguard S&P 500 ETF, a portion of your money goes directly into a company with negative equity, negative earnings, 55 billion debt anchor. You're not buying an aerospace innovator, you're buying a distressed, heavily indebted government contractor that forgot how to build aeroplanes. Boeing's PE ratio, 95 times earnings. Starbucks, 49 times earnings. Nike, 28. Home Depot, 23. Domino's, 22. All more expensive than Nvidia, Broadcom, Meta, Microsoft. Who would have thought? It's unbelievable. Yeah, the big tech companies who are actually generating true return on capital, have true pristine balance sheets. They're getting called potential bubbles, while these debt-ridden zombies who cling on to your 401k, cling on to your ETF for dear life, are being rewarded and kept in index. It's insanity. The S&P 500 is not a wealth building tool. Retail finance, FIRE movement, they all preach, or they just regurgitate what each other believe. Okay, that's the truth of it. It's like Chinese whispers. They just hear it from someone else, and they're like drones. Okay, that's what I've been taught, so I need to spit it out to someone else. Yeah, just invest in the S&P 500. You'll become rich in 40 years. And they just pass the information on. No one actually uses first principle thinking. No one actually looks at a balance sheet. No one does any research. They just quote stuff that they've heard. No one checks it. And the truth is, I wouldn't have a problem with them if they didn't say, see, if they said, invest in the S&P 500, you will preserve your wealth. I would say, that's fine. What I don't like is they say, invest in the S&P 500, you'll become rich. No, you absolutely will not. Stop saying that. If you want to tell someone to become rich, they have to make a concentrated investment that works out, whether that's their own business, which is or which is an investment in itself, or a concentrated investment portfolio, a couple of stocks. That's how you create true wealth. Just saying to someone you can passively make your way to wealth is selling them a pipe dream. I've already proved in many of my videos the actual real return of 10k into your 401k after 40 years. The true return is 20k of real purchasing power, which then gets taxed. That's why we structure our portfolio in a way where we have growth ETFs. What is the solution? I use the NASDAQ 100 as an example. Just an example, because it's a growth ETF. Yes, it's more volatile, but you're actually getting companies that need to innovate and need to grow, not just load their balance sheet with debt and buy back the stock. Buybacks are great if the company uses its own cash. Like Apple. Apple's the king of buybacks, but Apple actually has a healthy balance sheet. There is other blue chip companies that are healthy. The problem I have is I keep finding more of these, and these are big names, and people say, well, I know that name and I recognize it, so I invest in it, and it's just creating a domino effect of these zombie companies. They're not technically zombies yet. The definition, to be pedantic, is it can't survive its debt coverage. The point, you see what I mean? The point stands. The point stands. The S&P 500 is not a wealth building tool. It's preservation with volatility. You know, you're still getting, it's like a high beta savings account. We need true growth. Growth ETFs, if you do not want to pick companies, people want to say things like, you know, choosing a company is like picking a needle in a haystack. It really isn't. Because the winners are blatantly screaming in your face. The S&P is actually two economies in one. All the dead weight that I just showed you is dragging the index like an anchor. And then you've got the rocket ship or a Ferrari, which is all the big tech companies, which are actually generating true economic profit and economic growth and innovation. And they're dragging the whole index up with them. And people are actually like, oh, the concentration concerns me. Like, what do you want? You want these legacy companies to do something better? Well, I've just showed you what they do. They don't do anything. They just react to problems and use debt to fund buybacks. Why not just cut off the dead weight and invest in the companies that actually generate wealth, rather than being like, oh, I don't like the concentration. Oh, it's scary. You're scared of the companies that actually create wealth. Fine. It's all about emotional appeasement. This is the problem with most investors. It's just so hard for people to look at investing logically. Because you can see a Nike, a Starbucks, a Domino's, and a Home Depot, oh, I can touch it and feel it, therefore it's real and it looks like a big company, so I want to invest in it. Because you can't see a data center, you can't see cloud, you know, you can't see how much the advertisement companies are generating. It's hard to quantify because you can't touch it and feel it. But they generate true free cash flow, true wealth. And it's ironic that Wall Street do not punish these legacy companies for taking on debt if it's to fund buybacks. But if you take on debt to create the next industrial revolution of AI, Wall Street don't like it and they'll dump your stock. Yeah. It's just, to me, it's all backwards. It's all backwards. And focus on your growth. Focus on constructing your portfolio with a good balance of growth and defensive stocks. If you're planning on borrowing against the stocks, you must outperform monetary inflation, which is 7% on average, and the cost of your loan. And I rest my case.